All right, everybody, that music means we are back, not live at noon Central, 1 p.m. Eastern for Volatility Views. No, the markets are closed today for the Good Friday holiday in the U.S., so we're not monsters here, not going to make people come in on their holiday to talk vol. So unfortunately, you'll have to wait a week for your next live fix of all things Volatility Views. But you know what? We're not going to leave you hanging in the interim. First off, let's pay off our crystal ball from last week, shall we? Because in our infinite wisdom, we picked VIX closes, forgetting that it was going to be a holiday this week. So it was myself, it was the Rock Lobster, and of course, Mr. Jim Carroll from Ballast Rock on the show last week. And we all had a 12 handle. I was at 1245, so I was feeling the highest for VIX. Andrew, the Rock Lobster, at a 1212. He was the lowest, and Jim at a 1221. So neck and neck, those two there. And we were all fairly close, but no cigar. VIX just ticking over into a 13 handle with today's close, 1301 to be precise. So no winner chicken dinner for us on the show this week. That's not all we have in store for you this week. We have something special up our sleeves because there has been a topic in the vol space that has been captivating vol twit and fin twit and the financial media for the better part of the last few weeks. It's a bit of a murder mystery, a bit of a whodunit. Quite simply, who or what is killing vol out there? Do we have a suspect? Has he been caught red-handed? Is it the legion of covered call funds out there? Are they to blame for killing vol? And can they lead to perhaps Volmageddon 2.0? That's the subject, that's the debate, that's the topic that raged across the network this week. So we thought we'd cut those very interesting discussions and debates and analysis together for you folks to enjoy here on a Good Friday holiday at your leisure. So if you missed one or all of them, first off, we're going to give you a taste of my discussion with Dan Passarelli on Options Bootcamp about this exact topic and what we feel is actually to blame for killing vol. We'll follow that up with a clip from the Option Block featuring myself along with Henry Schwartz from Cboe, Mike Tosaw from St. Charles Wealth Management, and our good buddy Andrew the Rock Lobster Giovinazzi from Option Pit, discussing, debating, and analyzing that exact same topic. And last but not least, we have a clip from our Advisors Option program featuring myself, our good buddy Mr. Matt Amberson from Orats, and our guest Nick Griebenow from Shelton Capital Management. Again, all discussing and analyzing and debating that same topic. It's a volatility murder mystery whodunit. Who is killing vol? Let's find out now, shall we? Let's get out there and see what's cooking right now. Dan, a lot of this debate seems to be centered around the growth in AUM, or indeed assets under management, of a lot of these quote-unquote derivatives income funds. When I say derivatives income funds, that's really predominantly covered call funds. Not a lot of funds out there blasting away at puts. There are a few. But the predominant nature of these funds are covered call funds out there. And for a long time, I've met with the folks at Morningstar many times trying to boost up their analysis of options-related funds. They kind of just lumped them all in what I used to term the options ghetto. Anything that used an option, whether it was income, protection, it was all under the same rubric of options-oriented funds. And for obvious reasons, that doesn't really work. I tried to convince them to change that, so with not much success. They didn't really seem to get the value of this space. I think they're starting to understand it a little bit more now, Dan, because a lot of people pointing out, the Journal and others recently, that assets in these quote-unquote derivative income funds really exploding over the last few years. At the end of February, according to Morningstar, $80 billion in AUM out there. It may not sound like a lot compared to your traditional just S&P 500 funds, but that's up from $7 billion at the end of 2020. The SEC made a few tweaks back at the end of 2020 that made it easier for ETFs to now buy and sell options. As a result, this class has kind of exploded. The largest one right now, the JP Morgan Equity Premium Income ETF, has almost $33 billion in assets alone. So it's over a third of the entire category, just that one fund out there. Dan, have you been aware of this rise in effectively covered call funds over the last few years, sir?
No, honestly, no, I guess I'm not. I mean, I know that I know that the strategy has gotten a lot more popular, but I guess not really that there's been that kind of a flow into it. No.
Yeah, apparently everyone and their mother slinging some covered calls, Dan. Now people are pointing the finger at that and saying that is the reason. This explosion of growth in AUM and these derivatives income funds is the reason that vol is so muted right now. A lot of people saying that. So this kind of debate in the vol space and in financial media kicked off a few weeks ago, it seems like. When Cboe came out with a report, they have Mandy Zhu over there. She used to be at Credit Suisse. She's been on our vol show a few times. A good vol and kind of macro strategist out there. She wrote a report titled Our Option Income Funds Suppressing Volatility. She points out the same things. I was just mentioning the growth of AUM in these funds and everything else like that. But she points out a few interesting data points that I would have expected to see if they were the culprit as well, which is first off, if these vol selling, these covered call strategies were to blame, or one would expect the call wing, the bid of the call skew in these to be just annihilated because everyone in the other is selling covered calls. And the truth is actually the opposite. Some of her research just from a few weeks ago shows that the bid in these calls is similar to what we saw back in the early days of 2021. So it's meme stock palooza land again in a lot of these single names, and it's getting pretty juicy in the indexes as well, which is not exactly the setup that you would expect out there. Also, you expect the volatility risk premium, the amount of juice you get selling implied volatility versus the actual realized would shrink. And actually, it's the opposite. That risk premium has increased quite a bit out there, as we're seeing, recently. Implied vol not exactly pricing in all the moves we're seeing out there in the marketplace. So selling vol hasn't exactly been the juiciest of strategies. So Cboe comes out and says no a few weeks ago. And then a lot of people coming out the other way now, including the folks over at QVR Advisors. They've been on our vol show a few times as well. This is, I think, Scott Maydell doing their research. He's been on our vol view show in the past. They write saying, have option selling strategies and funds suppressed implied volatility? The answer to this question is unequivocally yes. They don't beat the bush at all. They come out and say, you know what? This is the culprit. This is what's keeping vol depressed. They quote a couple of data points, including some charts from the Cboe. So kind of trying to hoist Cboe on their own petard, I suppose, by using their own chart out there. They say end users, by the way of option selling funds, aren't intentionally contributing to this suppression, but they are ending up doing it nonetheless at the end of the day as well. And the growth of AUM in these funds, they say, are the cause, and these strategies are contributing to a large structural dislocation in vol and have been doing so increasingly en masse since the post-Great Financial Crisis. So they say this goes all the way back to the end of GFC. And now, not to be one to miss out on a trend, Dan, the Wall Street Journal jumping into the fray this week as well, writing an article entitled The Short Vol Trade is Back, Why Some Investors Think It's Driving Tranquility in the Markets. They again point out all these same data points I just brought out, the growth in AUM over these funds over the last 4 years, and some of the tweaks that have allowed them to grow, and also saying these funds are now to blame for tamping down on volatility. And they quote a lot of people in the article saying effectively that Eric Metz, who's been on our network in the past as well, he's over at Spider Rock now. He said, I don't think it's a coincidence. I do think it's a function of demographics. So that's kind of interesting. They also kind of try to tie it in, Dan. This is where I think they stretch a little bit. They try to tie in this vol selling, which again, all these funds are mostly covered call funds, into the next Volmageddon. This is a reprise of what we saw back in 2018, which was, of course, XIV, which was an inverse VIX fund, which is a completely different beast than a covered call fund. But they try to lump them all into the category of selling vol at the end of the day. And can this lead to a Volmageddon 2.0 as a result? Because everyone's now a short vol out there. I think saner heads are probably prevailing on that one. But a lot of things to debate here, Dan, that are kind of interesting. First off, we'll get to the Volmageddon stuff in a second. I have to charitably conclude that hopefully some editors foisted that on the reporters, and that wasn't their supposition to begin with out there. But I'll have to go look and see who wrote that article for the Journal. But that said, Dan, before we get there, where do you fall on this great vol debate right now? assets under management exploding in covered call funds. Is that what's keeping us at this extremely, at least for recent history, low level of VIX?
Yeah, I mean, it's something that can. The interesting thing about it is the whole point of short volatility is, well, I mean, the point of it is you do it when it's overpriced and you collect theta, but what comes along with that is negative gamma, right? And so when the going's good, the going's great. But what the problem ends up being is that like 3 sigma move when something kind of crazy happens, because then stuff really can get exacerbated fast. You know, and it's kind of the same old thing with this conversation where it's like, hey, everything's going great, everything's fine, yeah, there's no problem, everything's fine, and then when something blows up, which it happens every now and then, it's definitely one of those black swan type events. But as we all know, they call them black swan events because they happen more than they're mathematically supposed to. When they happen, then everybody in hindsight says, oh, yeah, I mean, of course, that's what happened. Like, why did that exist? And right now, people are benefiting from it. It's easy money. It's shooting fish in a barrel. It works until it doesn't work.
Yeah, you know, I think the data points that the Cboe points out are kind of interesting. First off, the fact that you think it was all covered calls doing this, Dan, you think the call wing would be crushed, right? And that is not the case. Single names, equity indexes, the call wing is juicier than it has been in quite some time, since effectively back in 2021. You got to go all the way back that far. So people are obviously buying upside. They're not just selling it. So that's the first data point. I think the point about the volatility risk premium is also interesting. So those are the 2 data points I look at. And also the fact that we are kind of continually moving north in the markets out there. Some days it's aggressively north, but still, at the end of the day, all those factors should probably conspire to keep vol at some fairly low levels. Now, that doesn't mean everything is tranquil. You look at some of the skew out there, that's interesting, what's going on in some of these products out there, what's going on in index puts and everything else like that. That certainly is intriguing. The other part of this article, Dan, that I took issue with was this. They say these funds are a different take on the short vol trade that blew up in spectacular fashion 6 years ago. A February 2018 surge in stock market turbulence led to the collapse of 2 volatility exchange traded products in an episode that became known as Volmageddon, causing huge losses for many individual investors. The blow up rippled through the broader market and fueled further selling. I think it's a stretch, Dan, to link a JP Morgan covered call fund. So you're selling, what, I'll have to look at their prospectus, 5%, maybe 10% out of the money calls in broad indexes for the most part. Linking that to an inverse VIX product like XIV, which anyone who was sane knew that product had, they even said it in their prospectus. There could be an unwind event, right, where they knew VIX has no theoretical limit to the upside, and they were short it. So they could very easily be, quote unquote, unwound, which was driven to zero. And that's effectively what happened with that product. I don't think selling covered calls in a large index and managing an inverse vol book are exactly the same thing. Do you, Dan?
Yeah, no. No. But I'm not going to play devil's advocate because
play it. Let's do it. Let's have fun. Let's play.
Yeah. I mean, it's not the same thing, but when we're looking at some of these short volatility funds, what we have to consider is what's on the other side of that trade. And when the shares are traded there, like there's arbitrageurs on the other side of that are laying off the risk, and what they're doing ultimately is some sort of option selling activity in the market and acquiring negative gamma. And I guess this is kind of where I was going with this in what I said leading up to this. I mean, I guess maybe I got a little bit ahead of our conversation here. So yeah, I mean, it's clearly a different thing than the Volmageddon stuff, like, you know, doomsday scenario that happened, but there is a little bit of a commonality in that it is introducing a lot more big money negative gamma. And when that stuff happens, like you end up having, basically what people nowadays call a gamma squeeze can happen, and it can just exacerbate stuff.
Of course, when you talk about the gamma squeezes, famously back in 2021, that was where people were buying a lot of upside, right? So the market makers, like we were talking about earlier, were taking the other side of that. So they were short infinite upside. So they kept blowing through strikes that they were short to the upside. They were short gamma, so that kind of led fuel to the fire. The hypothesis of this article is the other way, that they're loading up. They're choking on upside, right? They're long gamma for days. In that scenario, I think that the chances of a squeeze from a gamma perspective on the market maker side, you don't really exist, at least to that same extent. So I think it's kind of a little bit hyperbolic. I get it. You have to sell papers at the end of the day. You got to drive clicks on the websites. I understand throwing a little bit of Volmageddon in there. It is fun to just say Volmageddon. I get it. But I don't think the prospect of a lot of funds, 80 billion under AUM, selling covered calls on a fairly routine basis is the same thing as a product that has to be inverse VIX all the time. And when VIX goes to 80, guess what? That product goes to zero. I think for the most part, there's obviously another culprit out there, I think, that's keeping vol suppressed. They don't even talk about 0 day in this article. I don't think we still really fully understand the intersection of all this flow, 50% of SPX flow and all these other indexes flowing into options that are listed and expire in the same day. That's obviously going to have an impact on how the rest of the options trade and performs. I don't think we fully understand even that yet. There's a lot of other shoes to potentially drop. I'd be curious for you folks out there. In fact, this might be a good question of the week for next week. Producers, take note about, do you believe what the Wall Street Journal is selling out there? Is it the growth of assets and all these derivatives income, aka covered call funds, that are to blame out there, listeners, for all this madness in the vol space right now? Hit us up. Let us know. I've talked about this already this week. I'm curious what everyone else thinks out there. Let's go out to Cboe East first. Mr. Flowmaster, I have a feeling I know what you're going to say because your colleague Mandy Zhu kind of kicked off this whole debate with her little research paper there. But what are your thoughts? Where do you fall? Are covered call funds killing vol? And also, are they going to take us off the edge of the abyss to Volmageddon 2.0, sir?
I love kind of what Mandy puts out, and yeah, it's pretty amusing because there's one of the Bloomberg headlines went by saying that there was a feud going on between the JP Morgan analyst and Cboe analyst, which was Mandy, about the cause of
Mandy, that hot-blooded lady out there just taking shots at everybody.
Exactly. So there definitely is a wave of these premium selling products. This is not really a new situation. Some of these have been around for years and years, but there's definitely been a pickup in product creation. You hear about all these, QQQY and IWMY, and then they even have them on single stocks. And there's definitely, sometimes I call it a gold rush in the ETF creation business in these products that sell options. However, even with a big pickup, I think Matt Moran from Cboe had a chart on the growth of option use in 40 Act funds, and that assets were close to like $60 billion now. But it doesn't actually translate into that much premium for sale. In fact, if you look at there's one that I follow, QQQY, which basically sells a one-day put in NASDAQ every day, and you can actually, if you look at the trades in the last 5 or 6 seconds in NDX, the index options, which are really not a super active product, so it's kind of easy to see. You'll see basically a 70 lot being sold every day around 359, 52. And it doesn't add up to a ton of Vega for sale in terms of this vol dampening situation. And Mandy's is spot on in terms of, what we're really seeing is not just low volatility, but very, very flat put call skew, meaning puts are really cheap historically versus the at the money vol, and calls are really expensive versus at the money vol. And these premium selling funds, most of them are callers, right? So they sell some sort of an out of the money call. And even that giant roll that we're going to see today in SPX is a put spread caller. So they sell a call and buy a put spread. That is also a premium selling, a Vegas selling product. But exactly like she said, you would expect to see the call wing actually really depressed. And what we're really seeing is she's done some great work, and it's very cool. She's kind of inspired me to dig some stuff up. But one of them is basically just looking at your volatility on up days minus down days versus down days. Separate it out. Don't just say, okay, SPX is realizing 10 vol, but say, well, let's look at the down days and let's look at the up days. And it's very clearly, mathematically, the up days have been bigger. They've been more volatile to the upside, which is really kind of abnormal. It's not how we were trained to think of the down days as being the scary days. And that absolutely translates into the kind of the volatility structure that we're seeing, which is basically there's not a lot of fear out there about downside moves, and we're not actually getting the downside moves, so it all makes sense. And we are seeing some pretty violent, moves to the upside. And that therefore you're going to see basically those calls are very dangerous to sell effectively. So people, people price them a little bit higher. So, I absolutely do not think, and I told the Bloomberg panelists in London that, these products are leading to anything dangerous. None of them are levered, right? You don't have the TVIX kind of unwind potential, right? You have products that may be selling volatility as part of the strategy, but it's basically kind of 1-to-1 with the notional value. So if we get a big volatility shock, they're going to lose money, right? These are short vol products, but they're not going to go down to zero and then get liquidated. They're just going to take a hit, and and literally, if you look at the performance over the last 6 months or a year, it's really very good. And that's pulling a lot of people in too. I think what we need to make sure of is that people really do understand the risk they're taking. So, because sometimes, especially retail customers, look at something with a really high dividend yield and go, oh my goodness, this thing's yielding 30 or 40%. And they want to put their money in it because they think they can live off of the dividends. And when that yield is being created from premium selling, it has the potential, and over the long run, eventually it'll happen. It has the potential of losing a lot of value very, very quickly. And that's the one thing that I kind of worry about.
Yeah, a lot to unpack there. I'm definitely with you on the whole Volmageddon things. I don't know why they even put it in the article. It seems like it's apples to violins. They're not even the same thing at all. But that's a conversation maybe for another day. I want to let anyone else who has thoughts on this chime in. Maybe because it's interesting and we have no vol views tomorrow, I'll have our editors cut all these debates we've had this week together into maybe a special edition, a special report of vol views. Uncle Mike, Mr. Rock Lobster, any thoughts on this? Are covered call funds killing vol A, and B, are we headed for Volmageddon, easy for me to say, 2.0 as a result?
Well, I think that when you're doing a covered call fund, because we have an SMA that we use, we call it the triple income. And whenever I'm talking to clients about it, you got to be very careful about promising income. And in the stockbroker class 101 or whatever, and all the series 6 and series 7 and all those tests that I took a million years ago, one of the things that they really pushed is that if you're pitching a mutual fund, you can't sell the dividend. Meaning that you can't say, oh, this is going to have a dividend coming up soon, so you should buy this fund. Because of the fact that technically, whenever there's a dividend, the value of the fund goes down by that amount. Now, of course, it can come back, it can go up, it can go down, whatever. But because the dividend doesn't make it a better thing. It can, but that's just another tool for it. And by the same token, whenever you're pitching covered calls to clients on how great they are, they do this, that, or the other, you've got to be very careful about not saying, oh, this yielded 8% last year, 10% or 12% or whatever, because of the fact that just like in the dividend world, the dividend might go down and you might not be able to do it. And in the covered call world, well, volatility may go down, so you have to be careful with it. The problem that I've seen a lot, more so in the dividend world than in the covered call world, but I think it could be coming to the covered call world, is that even though you can't legally sell the dividend to people or pitch the dividend to people, it gets done. And my concern with all of this additional AUM going to covered call funds is, number one, people aren't going to know what the heck it is. But number two, just because you're able to get a certain yield on covered call premium one year doesn't mean it's going to happen the next year. And then what'll happen, my concern is that people are going to start selling in the money covered calls, so that way they can continue to get this yield. And that doesn't give you what you really need, because you're selling intrinsic value and it's not really helping what you originally were trying to do overall. Now, if you're selling in the money covered calls, there's nothing wrong with that. But if you're using that as a form of income, that can be a problem. And so I could see it being a problem if, and only if, covered call fund managers have to start altering their strategies because they get pressure from management to create that yield in one way, shape, or form. Or they start buying stocks that are way too volatile for what they were originally trying to do. I could see problems happening that way, but I don't see it happening just because of the covered calls themselves.
Mr. Rock Lobster, the final word, I should say, is yours if you would like it, sir. What are your thoughts on this whole debate, sir?
So they're saying that the covered call fund could blow up. I mean, they're just buying stock, right? And then they whack some calls against it.
Yeah, that's pretty much it.
So unless everybody hits the exit, right, on their covered call fund, but they're not going to do that till after they get their statement. You know, they realize, wow, you know, because a covered call is just a short put. So, you know, and mostly they're supplying vol to the marketplace. So as ex-market maker, you know, okay, you got these call riders coming in like crazy, and it just makes you massively backspread. So the market falls apart. Not really a problem for the liquidity providers, so they're usually have to buy stock back. And the covered call riders generally are not going to buy their calls back at all. They're going to keep their stock. It's going to suck. And then they go look for another, you know, calls to sell. So I could see how it adds liquidity, just like all call sellers do. Would it dampen vol somewhat? I would say yes from the supply, but judging from the amount of vol being sold, you know, I don't know. Now, the difference would be are they selling these calls? Are they writing against VXX? Because even then, you know, vol, you know, so I guess it depends where they're writing the options. But I don't see how a covered call fund by in itself is going to create market liquidity problems, because all they're doing really is supplying puts to the market, which is not a big problem. So I would kind of err on that side, that I don't see how they're creating problems. I think the problems will be when the market actually goes down. You have a quarter that might be down 10 or 12% or something, and everybody sees their covered call fund, you know, and the covered call fund will do better than the S&P 500 in general, because at least they have the short calls that they sold that went on worthless. So I don't know. I guess maybe it's just an excuse for people to be angry about something.
Yeah. Our chat's not buying it either. They're saying Wall Street Journal is crazy. They're looking for clickbait with Volmageddon. Probably a little bit of that as well. People click on things when you put Volmageddon in the title or in the article somewhere. So it is a bit of a leap. The better debate to be had around whether or not these covered call funds are killing vol. I do, again, think the data points of the call skew and the volatility risk premium kind of put that to bed, but, this debate persists nonetheless. So we shall have it here on the show. but a lot of data to unpack, a lot of counterpoint. This is very much the topic du jour in the world of options and indeed volatility. So I want to go around the horn, get each of your thoughts. Nick, as our guest, we'll start with you. What are your thoughts on this debate? Do you think this massive growth in AUM and these derivative income funds is to blame for the quote-unquote suppression of volatility we're seeing right now? Or are there perhaps some other culprits to blame out there?
Absolutely. I mean, I think that it's hard to argue that the increase in covered call writing funds could be suppressing volatility premiums to an extent, but I don't think it's an apt analysis to say that it is the entire driving force behind it. Like you say, volatility has been uniquely low recently, but not just in equity markets. It's across asset classes, it's kind of across the board. And then, as Matt said earlier here, the IV of SPY relative to its components, he said was around 45%. Volatility has been very low, especially on indices recently. It's been quite muted, but single stock volatilities haven't been muted to that same extent. And a lot of these covered call writing funds, certainly there are some out there that write index options and 1256 contracts and, against SPY, but there are also a lot of them out there that are writing individual equity options. So if they were the primary driver, in EQTIX, we're not writing index calls. We're writing calls against the underlying securities. If that was really where all this volatility suppression is coming from, you would expect to see more of that reflected in single stock volatilities than just in the indices. And I think, again, it's been across the board that volatilities have been deflated. So looking just at derivative income funds as a source for that suppression is ignoring, I think, a lot of these external factors and these other components of it's outside of what we're focusing on and what we're trading that we're seeing this volatility suppression, kind of across the board here. So, I would fall more on the CBOE side of no, that it's not directly the responsibility or, coming from covered call funds themselves. They may be a contributing factor, but they're certainly not the driving force behind, low volatility across the board here.
Matt, same question for you. What are your thoughts on all these kind of conflicting data points and kind of the interesting nugget I think the Cboe pointed out early on in this debate that you would expect maybe to see the call wing taking more of a hit than it is right now, maybe reflecting some other factors are at work. But what are your thoughts on this counterpoint on the whole low vol debate, sir?
Yeah, I mean, the point at that, I think, is reaching. You got the Fed with a bunch of money out there, and I mean that's such a huge elephant in the room that it's hard to point at anything else. Probably, that's just a distraction. So it's the market. I mean, it's just going straight up. There's not much historical volatility. When we look at just kind of historic implied to historical volatility ratios, it's right around, pretty normal. So it's not doing anything to that relationship. Yeah. And then, like you said, and I mentioned earlier, if that were the case, you'd expect to see the calls really driven down. And it's the opposite right now. It's more of the meme stuff going on. It's these 5 delta IWM, which is, these small are really bid up. And so, if you really drill down to the numbers, that argument goes out the window pretty quickly, Mark.
Yeah, a lot of the data coming actually from that same source over there at Cboe, crunching the numbers a few weeks ago as well, showing that you're right. The skew in some of these names and indeed across the board in general is starting to return to 2021 meme stock levels. So again, not the setup you would expect if it was all of these covered call writers just completely depressing overall market volatility. I think it is fair to say there are probably some other culprits at work. Otherwise, these same covered call writers must be crushing the heck out of vol in pretty much all assets across the board to have similar vol movements out there. But what do you folks think out there, listeners? Maybe it might be a fun. We already have 2 questions of the week going for you out there. It might be a fun, maybe a follow-up question. Are you folks buying what a lot of folks out there in the vol space are selling, that these option selling funds are to blame for vol being fairly muted, or do you think perhaps something else is afoot?
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.